On Tanzania's northern coast lies the port city of Tanga. For decades, it operated in the shadow of the region's larger maritime gateway, Mombasa. But that may be changing. In August 2026, Uganda's national oil company, Tanzania's Petroleum Development Corporation, and global energy trader Vitol Bahrain signed a memorandum of understanding to develop what they call the Tanga Regional Energy Hub. The proposal goes far beyond simply exporting crude. It envisions petroleum storage, refining, logistics, trading, and distribution infrastructure designed to turn Tanga into a regional energy center. And officials say the wider energy push could attract more than $20 billion in investment over time. But that number needs context. The $20 billion figure is not a check for a single refinery. It represents the potential scale of investment associated with a much broader regional energy ecosystem. And that distinction matters, because Tanzania is not simply trying to build another port. It is trying to build an alternative energy corridor into the East African interior. For more than half a century, Kenya's Port of Mombasa has been one of the region's dominant gateways for imported fuel and inland trade. Now Tanzania has something Mombasa did not have before, a direct crude oil artery from Uganda. And that artery ends at Tanga. That changes the strategic equation. To understand why this matters, look beyond the coastline. East Africa has spent decades depending heavily on imported refined petroleum products. Landlocked economies such as Uganda, Rwanda, and Burundi can have access to energy resources or sit next to countries that do, but still remain vulnerable to the cost of getting usable fuel into their markets. The traditional model is straightforward. Import crude or extract it domestically, move it to the coast, ship it to a refinery somewhere else, then transport the finished petrol, diesel, kerosene, and jet fuel back into Africa. Every additional leg creates another cost, and every external supply disruption creates another vulnerability. That is why the strategic value of refining is much greater than simply the profit earned from processing a barrel of crude. Refining creates control over what happens after extraction. Storage creates resilience. Pipelines create predictable distribution. Trading creates market access. And regional refining can potentially keep more of that value inside Africa. This is the economic logic behind the Tanga strategy. Now follow a single barrel of Ugandan crude. Deep beneath the Lake Albert region are Uganda's enormous petroleum resources. The country estimates total petroleum resources at more than 6 billion barrels, although the economically recoverable portion is much smaller. Once commercial production begins, crude from fields including Tilenga and Kingfisher is designed to enter the East African Crude Oil Pipeline, or EACOP. The pipeline stretches approximately 1,443 kilometers from Hoima in western Uganda to Chongoleani near Tanga on Tanzania's coast. And this is no longer merely a line on a map. As of mid-2026, Tanzanian officials reported construction at roughly 86% complete, with the first crude shipment expected in January 2027. The pipeline is therefore creating something strategically important, a guaranteed flow of Ugandan crude toward Tanga. Under the original export model, that barrel would arrive at the coast, enter storage, and eventually be loaded onto a tanker for international markets. But the new Tanga vision asks a different question. What if some of the value stays here? Instead of stopping at crude storage and marine export infrastructure, the emerging hub concept envisages refining, petroleum storage, trading, logistics, and a multi-product pipeline linking Tanga with Uganda. In other words, crude could move east. Refined products could move west. That creates the possibility of a two-way energy corridor. And whoever controls the infrastructure between those two directions sits at a powerful position in the value chain. So why Tanga? The answer begins with geography. The EACOP pipeline is already being built to terminate at Tanga. That gives the city something extremely valuable, a major oil export infrastructure project already anchored there. The second factor is infrastructure expansion. Tanga's port has been undergoing modernization, while Tanzania is planning additional berth capacity to accommodate rising demand. The Port Authority currently lists Tanga with 2 berths and a 13-meter depth, while the government announced plans in July 2026 for a new 300-meter berth. And the strategic energy infrastructure is expanding alongside the port. At Chongoleani, the EACOP marine terminal is approaching completion. Tanzania reported in May 2026 that 4 crude storage tanks were nearing completion, with combined capacity of roughly 2 million barrels. So Tanga is gradually acquiring the physical ingredients of an energy hub: pipeline, storage, marine terminal, port infrastructure, and now a proposed refining and downstream ecosystem. That combination is what makes the location strategically significant. This is where the story becomes bigger than oil. Because Tanga is emerging inside a region where logistics have always been geopolitical. For decades, Mombasa has anchored Kenya's northern corridor. The corridor connects the Kenyan coast with Uganda, Rwanda, Burundi, Eastern Democratic Republic of Congo, and South Sudan. It is supported by established road networks, pipelines, logistics companies, ports, and inland distribution infrastructure. But Tanzania has been developing a competing architecture. Its central corridor connects Dar es Salaam and Tanzania's interior with Uganda, Rwanda, Burundi, and the DRC. Tanga adds another dimension. It creates the possibility of an energy-focused northern branch connected directly to Uganda's oil infrastructure. That does not mean Mombasa is about to lose its dominance. The northern corridor has enormous sunk investment, established commercial relationships, and a much larger logistical ecosystem. But competition does not require replacing an existing corridor overnight. It only requires creating an alternative, and alternatives have strategic value. For Uganda, an alternative route reduces dependence on a single maritime supply system. For Tanzania, it strengthens the country's position as a gateway for landlocked economies. And for the wider region, it creates competition over which coastline and which infrastructure network captures the economic value generated by East Africa's growing energy demand. The economic logic is straightforward. A country that simply exports raw resources captures one part of the value chain. A country that also stores, processes, trades, and distributes those resources captures more. For Uganda, the Tanga strategy potentially creates another route through which its petroleum resources can reach global markets while also connecting the country to a regional downstream market. For Tanzania, it reinforces the country's position as a maritime gateway for landlocked economies. And for Vitol, the opportunity is strategically familiar. Vitol operates across crude oil, refined products, shipping, storage, and downstream distribution. The company trades millions of barrels of crude and products every day and has substantial global refining and storage interests. That makes its participation significant. Vitol is not simply a construction contractor. It is a global energy trader whose business model depends on controlling and optimizing flows between producers, infrastructure, and consumers. A growing East African petroleum corridor therefore represents precisely the kind of market architecture in which a company like Vitol can play a major role. But there is a major difference between signing an MOU and building a functioning energy hub. An MOU is not a final investment decision. It does not guarantee financing, and it does not guarantee that every component of the proposed hub will actually be built. That is the first major risk. The second is capital. Large refineries, storage terminals, and cross-border pipelines require billions of dollars. And international financing for large fossil fuel infrastructure has become considerably more complicated. The third challenge is engineering. A regional petroleum hub requires much more than a refinery. It requires reliable crude supply, storage, marine infrastructure, product pipelines, cross-border tariffs, customs systems, environmental approvals, power, water, road and rail connections, and critically, a sufficiently large regional market. The fourth challenge is competition. Tanga is not entering an empty market. Mombasa already has established petroleum infrastructure. Dar es Salaam remains Tanzania's largest maritime gateway. And other coastal projects are competing for the same regional energy market. That means Tanga must prove that its infrastructure can compete not only politically, but economically. And then there is the question nobody can avoid. What happens if the world changes faster than these projects are built? East Africa's demand for transport fuel is still expected to grow as populations, cities, and industrial activity expand. But the global energy system is also moving toward electrification, renewables, and lower carbon technologies. That creates a difficult investment calculation. A refinery built to operate for decades needs customers for decades. A pipeline built today needs sufficient volumes tomorrow. Storage terminals need throughput. And investors need confidence that oil demand will remain strong enough to justify the capital deployed. This does not mean the energy transition automatically makes the Tanga strategy irrational. In fact, growing African energy demand could sustain petroleum markets for years. But it does mean that the largest projects face a long-term question. Will the infrastructure outlive the demand that was supposed to pay for it? That is the strategic gamble. For decades, the economic pattern across much of Africa was painfully familiar. Extract the resource, export the raw material, import the finished product, and watch much of the value accumulate somewhere else. The Tanga initiative represents an attempt to change that equation. But the real prize is not simply the crude beneath Lake Albert. The prize is everything that happens after the crude reaches the coast: storage, refining, trading, shipping, distribution, and the infrastructure connecting all of those activities to the consumers of East Africa. If Tanga succeeds, Tanzania will have strengthened its position as an energy gateway. Uganda will have a deeper connection to a regional downstream market. Vital will have positioned itself inside one of Africa's emerging energy corridors. And the Central Corridor could gain another strategic asset in its competition with the Northern Corridor. But there is an important caveat. Tanga does not have to completely defeat Mombasa to matter. It only needs to become credible enough that East Africa no longer has a single obvious energy gateway. And that may be the real geopolitical significance of this project, because once a region has two competing corridors, countries gain choices. And once countries have choices, infrastructure becomes leverage. So the question is no longer simply, where will Uganda's oil go? The bigger question is, who will control the infrastructure that connects East Africa's resources to its consumers, and ultimately to the rest of the world? The answer may determine not just the future of Tanga, but the economic map of East Africa itself.